WeWork. In your recent earnings, you lowered the valuation you carry your investment in WeWork in your books from 150 million down to 70 million, over 50% write down. What level of valuation does that leave WeWork at the top level for the company?
We're not going to disclose, how we mark our individual positions, but obviously that was an investment we made a number of years ago at a lower valuation. Over time, as the company was running processes and setting prices for liquidity, we, along with a number of other investors, took some liquidity in that investment, but we still have we still have an investment that's left. I think Stephen Scher, our CFO, said on the earnings call that at the current mark, even if it went down from here, we still have a profit in the remaining position. But we're watching that situation like everybody else, and it'll be interesting to see as they refocus the business how that business moves forward. But there is a real business that underlies that.
How do you think about the conflict of interest that you have a direct private investment in the company? You're also responsible for marketing, or were responsible for marketing the IPO to new public market investors. You want a high valuation based on your direct investment and versus a legitimate valuation for new public market investors. How do you weigh that conflict of interest internally?
Well, we've been an investor for years and years and years, and we've got a lot of experience in managing the fact that we have a broad investment portfolio, both for clients and for ourselves, and that we're in the capital markets. In the context of this situation, this was an investment that was made at the very, very early stage of the company. Of course, we want that investment to do well, but at the same point in time, we have a duty to investors as an intermediary to price IPOs so they work in the market, and those are two separate parts of the business, and we've always operated successfully through that.
Sure, and I know both of those types of business have gone on for a long while, but I guess this is a very high-profile example of where that all broke down. The S1 that was filed.
I'm not so sure that it broke down. Why do you say that it broke down?
Well, the IPO went away.
Oh, the IPO broke down. I'm sorry. I thought you were talking about the process.
Well, let me put it this way. This S1, of which you were the lead underwriter on and a co-lead underwriter and signed off on the S1, had the founder owning buildings where the company was a tenant, the founder taking multiple personal loans from the company at very low rates, the founder charging for the use of the name We, all male board directors, dual-class share structure that many people have questioned. You, I know, care a lot about corporate governance, and yet you endorsed this S1 and a high valuation, which if invested had gone for, you would have sort of approved it in one sense, whilst also being a private market investor. Do you think there are no conflicts of interest there whatsoever, and are you happy with how that all played out?
Well, there are always conflicts of interest for an organization like ours, and we do our best to make sure we're transparent where those conflicts exist. With respect to this particular situation, I think what's unfortunate about this, and I think it's a little bit of an adjustment, broadly speaking, with respect to the IPO process, there's been a lot of focus on growth at all costs. I think the IPO market is pivoting and getting much more focused again on growth with a path to profitability. I think as there's been focus on growth at all costs, there's been a more lax approach than I personally think's appropriate around governance, and I think that's getting corrected a little bit. And so even though this played out publicly, I do think that the process ultimately brought the company to a place where it may or may not would have been public, but the process, which was feedback from investors, feedback from banks, including ourselves, basically said this won't work unless you get it to a different valuation, different governance. Some of the things that you mentioned were changed through the IPO process and would have been different if the company had gone public. And the public never saw the valuation that the banks and the underwriters were telling the company we thought the valuation had to be in order to actually go public. So it played out a little bit more publicly than that process you'd normally like it to play out. But I think at the end of the day, the market process worked.
So moving forward, perhaps, the lessons learned from this, whether it was with Uber before it as well, which had some corporate governance issues which played out publicly, do you think that you guys across the board in the investment banking space should work earlier with these companies to get rid of those corporate governance question marks so that they don't come up again?
Well, look, our job is not to be the rule maker for what the public markets accept or don't accept in terms of governance, value, et cetera. It is our job to try to suggest over time what we think makes sense for investors and for markets broadly. And so that process will continue. We'll try to play our role in that process. But ultimately, the market makes judgments around these things as to what's appropriate, what's not. If you go back 20 years ago, there weren't a lot of high super voting stocks. And today, for a lot of these founder companies, there are. And in fact, there have been a lot of people that have advocated that there's benefit to that. You know, we'll see over time whether or not the market changes its view, but that's an evolutionary process. And our job in that process is to bring buyers and sellers, or the companies and the investors, together in an appropriate balanced process, and we'll continue to do that.